webinar that we're having. We did one prior to the election, and now we did that with AB, and now we're doing one post the election with Fidelity Investments. And we're honored to have Nosh with us today, who's Vice President of Capital Markets with Fidelity Investments, to give us an overview. And before we get into that, I just wanted to say, emotions have been high, concerns have been high on both sides. But from a market perspective, just what we have seen after the election is we've actually seen the VIX, which is that fear gauge, come way down. A little bit more certainty in, not on the finality of everything, but as Nosh will explain, what we do see in the market. So with that, I'm going to turn it over, and Nosh is going to go through a presentation, share his screen, and then we'll have some comments afterwards. Thank you so much for joining us and keeping yourselves on mute, and then we'll go through this presentation. Nosh, thank you once again for being with us. You have addressed our clients before at other times, and thank you for making yourself available this afternoon to go over this post-election perspective. So with that, Nosh, I want to make sure you have the ability to speak. Great. And share your screen.
Thank you, Loreen, and good afternoon, everyone. And as Loreen mentioned, this has been a volatile year. We've all been through the virus issue. And on top of that, we've gone through now an election. And a week from the election, there are still a few question marks. It's raised a lot of emotional fear, anxiety. So let's try and look at what we know from history, what we know today. And at the end of the day, we as financial analysts, as financial advisors, as investment advisors, we are here to guide you and to provide you with information regarding investments in a sense. And ultimately, what I want to do is to separate out some of the rhetoric which comes from both extremes and to actually provide you with real historical data, what we see in the markets, what we expect going forward. So sitting today, since the beginning of the year, we kept on hearing this talk that in a presidential election year, bad things happen, volatility increases, the markets tend to crash. And that notion has come about simply because of the recent past. And what I mean by that is that in 2000 and in 2008, an economic downturn just coincided with a presidential election year in a sense. So that doesn't happen every time around. So just to prove that statement wrong, what we did was we went back 70 years in history and we said, let's look at how the markets behave in every year of the presidential cycle. So year one, you get average returns of 7%, year two, 6%, year three, 16.1, year four, 6.3. So year four is actually an absolutely normal year lying somewhere between year one and two. The outlier year is actually year three. And the reason being, every politician wants to get re-elected. So usually in year three, what we get is a fiscal stimulus or a monetary stimulus, which gives a boost to the economy, which gives a boost to the equity markets. So the first thing that we wanted to clear up is that just because we are in a presidential election year, you don't have to sell equities and go to cash or anything of that sort. The second thing that we wanted to look at is, does the market trade differently during a presidential election year? So we took years 1, 2, and 3, and we averaged it out. So definitely the average went up to about 9.5%, and we compared that to year 4. So the red line is the average of years 1, 2, and 3. And what you see is normal volatility across the year and average returns of about 9.5%. The presidential election year does have a very distinctive trading pattern. So let's first look at the first half. So in the first half, what we see is a lot of volatility, but the market really doesn't provide any returns. And the reason being, Wall Street doesn't like uncertainty. So Wall Street wants to know who are the two candidates, what are the issues that they're standing on. And usually we get that clarity as we get closer towards the national conventions, which are usually held during the months of June, July, and August. So once that clarity is received, market goes up about 5 to 6% till we get to the last 4 to 6 weeks. And then we get into the debates, the scandals, and we get a little bit, I would say, 2.5 to 3% of volatility. And once we get past the elections, which is to say the political uncertainty is behind us, the markets provide your very typical fourth quarter rally. So if you actually look at the fourth quarter, the red line and the blue lines actually look very similar. So once the political risk is behind us, the market starts looking forward. And sitting today, if you just look at the S&P 500, it's actually up about 12%. So compared to the average of 6.3, it's actually done much better. Having said that, yes, we still have 50 odd days till the end of the year. So sitting today, what is it that we know with regards to the election and what are our expectations going forward? So let's first look at the three executive chambers, starting from the House. So we know that the Democrats will keep majority in the House, but it is a significantly reduced majority. So what that means is that they will have to move more towards a bipartisan role, compromising on certain issues with the Senate and the next president. Then we go to the Senate. So as of the present, the Republicans hold 50 seats, the Democrats hold 48 seats, and the 2 seats in Georgia are up for a runoff election on January 5th. So the base case scenario is that the 2 seats in Georgia get split. The Republicans keep a very slim majority of 51 to 49. So that means even the Republicans have a much lower majority in the Senate, and they will also be forced to work in a bipartisan manner. So what this essentially means is that we are heading for gridlock. And gridlock historically has been very good for the nation, for the economy, and for the markets. The reason being, when we have gridlock, only good bipartisan laws can be passed, and nothing radical either from the right or the left makes it through. So keep that factor in mind. Now, gridlock can be good, and in some cases, it can also be bad. So the bad instance was Newt Gingrich with Bill Clinton, which led to an elongated government shutdown and things of that nature. As of the present, what we see is good gridlock. And we got an early indication of it when the day after the elections, Mitch McConnell, who's the leader of the Republicans in the Senate, came out and said 3 things. So 1, economy does need a stimulus. So that's very good. Two, he mentioned he's willing to compromise on state and local aid. So that was something he was not willing to compromise before the elections. The third thing which he said was that he was looking forward to a smaller than expected package. So the Democrats before the elections were insisting on a package of about $2.2 trillion. The Republicans had agreed to somewhere between $1 to $1.5 trillion. So that's kind of the bad part in a sense. Now, with the Georgia races scheduled for January 5th, our expectation is that there is going to be no stimulus before that. So fourth quarter is going to be a struggle for a lot of consumers, and we wouldn't be surprised if retail sales after Thanksgiving, after Christmas, will come on the weaker side of things. And that's, again, consistent with what we are seeing with a few close downs taking place because of the virus. But the key thing that I wanted to point out is fiscal stimulus. And we want to talk about two different fiscal stimulus at this point in time. So the first one that we've been talking about is a package which is going to be very similar to the CARES Act, which passed during the summer. So essentially, aid for unemployed people, the payroll protection program, aid for healthcare services, hospitals, things of that nature, and then aid for state and local governments. So no focus on infrastructure, the primary focus being on aiding the common person with unemployment benefits and the payroll protection program. Now, as we go through 2021, our expectation is that they will also start discussing a fiscal infrastructure stimulus package. That is going to be in the range of somewhere between $2 to $2.5 trillion. And the focus of that package is going to be on building out digital infrastructure. Now, when I say digital infrastructure, basically it implies building out 5G infrastructure and then all the applications and services on the back of it. And that will be a multi-year program which probably kicks off, I would say, extremely optimistic, end of 2021, more likely through 2022, running for at least the next 3 years, getting to about 2024 in a sense. Now, keep this fiscal stimulus factor in mind when we go to the next slide. But where do we sit with the presidency today? So the immediate risk is one of litigation. So before I talk of litigation, let's go back to 2000. So in the 2000 race, it was also a contested election. And there was litigation all over the place. But there's a big difference from what we are seeing today. So in 2000, the litigation was confined to the state of Florida and to about 3 or 4 counties. And the sole issue was all about recounting the votes. Sitting today, we are dealing with multiple states, multiple counties, multiple issues. So we've introduced a lot of complexity and a lot of uncertainty with this litigation risk. And over the next...
Nosh, can I just interrupt for a moment? I don't think your slides are changing. Can you just check that to see if we're on the right slide?
So no, we don't have anything on litigation risk. I'll get to the next slide in a minute.
Thank you so much.
Okay, so in terms of litigation risk, as an investor, one has to step back and ask the question, what is the objective of litigation? And litigation can serve two purposes. One, is it legitimate enough to overcome the expected results of the election? Or is it being done to boost the chances of the two candidates in the Georgia race and to set up President Trump for a 2024 run? At this point in time, we have no idea what the objective of this litigation risk is, but very likely over the next 7 to 10 days, that will become very clear. So then we get to one very important date, which is December 8th, also called the safe harbor date. So by December 8th, every state legislature has to count all the votes, verify them, ratify them, and all litigation needs to be resolved. So if everything stretches till that date, it's fine. So even in the 2000 election, everything was resolved by the safe harbor date. If litigation continues beyond that date, then we are looking at significant volatility and uncertainty coming into the markets. So keep that date in mind. Till then, it might be just a lot of political rhetoric in a sense. One other immediate date, which is November 20th. So the Secretary of State in Georgia came out this morning and they said, because the race was very close, they are now going to do a hand count just for the presidential election in a sense. So that will take place over the next 10 days. By November 20th, that result should be out. And I wouldn't be surprised if it happens also in 2 to 3 other states. So there is that little bit of uncertainty over the next 10 days or so. So again, coming back to the fiscal stimulus. So why is that important? So over the last quarter, we kept on hearing that if Vice President Biden is elected, or if there is a blue sweep, taxes will go up, and therefore everyone should be selling equities. So we said, let's take a look at all of this ourselves. And our conclusion was that we would broadly agree with the first part of the statement, which is to say, if Vice President Biden is elected, or if we get a blue sweep, there's a high probability of tax increases taking place. But we totally disagree with the second part, that one should be selling equities. And the reason for it is that we actually found contradictory data. So focus on the bar chart on the left-hand side. So baseline, in any given year, when there are no tax increases, the market goes up 9% on average, 72% of the time. But what we notice is that when personal taxes were increased, the market actually went up on average 14%, 88% of the time. When corporate taxes were increased, 13% increase on average, 100% of the time. And capital gains, 11% increase, 80% of the time. So this led to a lot of head scratching as to why do tax increases actually deliver above average equity returns. So we went back in history and we asked the question, what else was happening when taxes were raised? And what we found is that tax increases were usually accompanied by a fairly large fiscal stimulus package that led to an increase in job creation, an increase in wages, and that translated into above average economic growth, and that led to above average equity returns. So the bottom line of this study was that don't get swayed by headlines that you're hearing today. Wait for the entire fiscal picture to become apparent, and that might take 2 quarters, may take 3 quarters. Once you know all the facts, then sit down with your financial advisor, with your tax consultant, see what your individual position is, and then take a rational decision. So just don't go by the headlines that Vice President Biden has been elected or there's a likelihood of a blue sweep. You need to get out of equities and go to cash today because taxes might increase next year. Okay. So at Fidelity, we actually put minimal weightage on political outcomes. So what are we looking at today, which drives our investment decisions? So the first key factor is, where are we in the business cycle? So about 4 to 5 months ago, the entire global economy was very much at the bottom of the recession. Today, we are very much in recovery phase, what we call as the early cycle, and the global economy today is being led by the Asia Pacific region, primarily China, followed by Europe, and then you have the United States and United Kingdom. Now, why is it important to recognize where we are in the business cycle? So where you are in the business cycle, it tells us what you should expect as investors in terms of returns, as well as risk and volatility from different asset classes. So essentially, it's a guide towards doing our asset allocation strategy. So sitting today, we continue to take what we call as a barbell approach. So in plain simple English, what it means is that on one hand, you want to own defensive investments. Now, why is that? The reason being, we still see risk coming from the healthcare side of things, from the political side of things, from the stimulus side of things, and who knows what geopolitical risk lies ahead for the next administration. So to overcome those risks, you want to own what we call as core bonds, which is nothing but US treasuries, US mortgages, investment grade credit. Now, on the other hand, you also want to own offensive investments. And that is primarily equities, because they tend to do very well during early cycle. Now, within the equity space, our preference today is very much for large capitalization companies. So why is that? So large capitalization companies tend to have stronger balance sheets, much more flexible balance sheets. And what do I mean by flexible balance sheets? What it means is that the company is able to undertake different functions, right? Research and development, capital expenditures, sales and marketing, under all kinds of adverse economic conditions. So if you can do that, basically you're continuing on your roadmap of creating new products or services, maintaining your pricing power, maintaining or growing your market share. So those are the kinds of companies that we are preferring to own today within the domestic space. and most of them happen to be large capitalization companies in a sense. But if you came to me and you put the question to me that I have money to put to work, I'm a long-term investor, I can take on a certain degree of volatility, essentially what you would be asking me is, where do I see the best risk reward today globally across different asset classes? And the answer to that would definitely be international, more so emerging markets, and for various reasons. So firstly, much better cyclical growth. So today, globally, we know the Asia Pacific region, led by China, is at the forefront of driving global growth, followed by Europe, and then you have the US and UK. Then the second factor that we are looking at is valuations. So sitting today, the US market trades at a premium of about 10% compared to its long-term price earnings average. So I would say a tad bit rich in a sense. Compared to that, when we look at developed international, which is nothing but Europe and Japan, they trade at a discount of about 5 to 7%. So yes, there's a big discrepancy in valuations. But what is really cheap is emerging markets trading at a significant discount of 7 to 10% compared to the price earnings long-term average. So emerging markets are relatively very cheap at this point in time. Now we go to the longer term structural drivers. So we know that emerging markets continue to grow at a much faster rate, driven primarily by their younger populations. So how do we go about exploiting this younger population demographic theme in a sense? And there are three underlying themes to it. The first one being the build out of infrastructure. So roads, rails, bridges, power plants, all continuing to get built out across the emerging market space. Then we come to the biggest factor, consumption. So more people entering the middle class incomes growing, leading to higher consumption of consumer staples, healthcare products, and then you get into discretionary spending of apparel, retail, travel, leisure, and then the big ticket item of automobiles. And the final theme being technology. So increasing usage of smartphones, which leads to increasing adoption of electronic finance, electronic commerce, electronic banking, and then on the side, you have online gaming and online entertainment. So these are very long-term structural themes that we've identified, and we continue to play them. More importantly, they've also been very lucrative investments for us. And one thing I forgot to mention is on the domestic side, if you're into sector investing, the healthcare sector continues to be a number one top pick, and for several reasons. One, every election that we've gone into over the last 30 years, there's always been this talk of the possibility of Medicare for all. So every time we go into an election, the healthcare sector sells off. It starts trading at a discount to its historical average. Once we get past the elections, and in the past, and even sitting today with a Democratic Congress, a Republican Senate, so gridlock, it's highly unlikely we will get Medicare for all. So with that risk being taken off the table, we see some appreciation in valuation coming about over the next 6 months to a year. So that's just a valuation argument. Now let's look at some cyclical factors and some long-term structural factors. So from a cyclical perspective, two things. One, in the CARES Act, which was about $3 trillion, $350 billion was allocated specifically for healthcare. And most of that money will be deployed in basically refurbishing hospitals in a sense. So very positive for medical device and equipment companies. Now, while we went through the virus crisis in the first half of this year, a lot of elective surgeries like ankle, knee, hip, shoulder surgeries, gynecological procedures, dentistry procedures, cosmetic procedures, all of those were postponed, which means there's a very big backlog of those procedures which are built up. And those are also very positive for medical device and equipment companies. And when we look at corporate earnings, and this might surprise a lot of people, healthcare on average as a sector has actually outperformed technology earnings as an entire sector. So again, some of these elements have played out, some of these elements will continue to play out. But let's look at the long-term drivers, which all comes down to demographics. So sitting today in the US, we have about 52 million baby boomers above the age of 65. That number increases to 72 million over the next decade. So the sheer volume of people requiring healthcare assistance is going to increase. And that doesn't depend on who takes power across the different executive chambers next year in a sense. Secondly, we know that as we age, our spending on healthcare increases very significantly. So anyone below the age of 45 spends about $3,000 to $4,000 on health.
Nosh, I think we lost you. Can you hear me? Okay, I think we lost Nosh. Let's see, Ted, are you on the line? Or Ashley? Ashley, I think you're on the line. Ashley, can you unmute? Okay. We're not sure what happened to Nosh. So while we're waiting for Nosh, I'm sure he's going to come back. Let me just go through a couple points that he made that we completely agree with. So we are using Fidelity's healthcare fund. It's a top pick for us as well. We have an overweight in healthcare. Nosh also mentioned high quality fixed income, which is something that we did earlier in the year, was increase our credit quality on our portfolio. And we're using TIPS, which has been one of our best positions, Treasury inflation protected bonds, as part of our fixed income allocation. He also mentioned large companies with strong balance sheets, which has been a theme for us since the decline in March. What we've been doing is focusing on some of those companies like Walmart, like Microsoft, different large cap companies that we knew could get through the pandemic and beyond. And then he also discussed the international play and emerging markets And he talked about the cyclical growth there and the valuations. And I'd add the third part that we see with that play would be that the US dollar is in a decline, meaning that we're seeing a lower dollar right now. And with that dollar, lower dollar, that also helps that international trade because you have a plus on the currency. Nosh, are you back?
Yes, sorry, my connection just dropped off suddenly.
No
When I
worries.
just said thank you, it just blew up automatically. I don't know
I
why.
was just going over some of your notes that
Yes,
you were
yes,
talking
please
about.
do. Please continue.
And just talking about how we agree with some of those things as well. So really, I was done. I was just going through some different points, and go ahead and continue with your presentation.
No. So I just said thank you and it went off. So please continue with your comments. And if there are any questions, we'll open it up.
Okay, so you were done with your comments at that point? Oh, okay, perfect. Okay, so, and I was just giving a summary of kind of where we see things which were in agreement with what you had to say. I did have, let's see, I had a question for you. Oh, so, and Ashley and I have been talking about small cap value. You know, what we see is such a disparity between small cap value and large cap growth, and really see that as an opportunity, and in an early stage recovery is an area that tends to do well. Could you comment on that?
Very good question. So what I would say is that over the last 2 weeks, we've definitely recommended to investors that you start putting small cap value on the radar for most investors. For your aggressive investors, you start dabbling in it at the margin in a sense. And the reason I say that is that we are starting to see two catalysts on the horizon. So it's not come to fruition as yet. And what I mean by two catalysts is, one is the announcement about the vaccine. Now there's still a question mark whether it'll work, what is the efficacy, how fast will it get implemented, and on the back of that, how fast will be a recovery. But definitely from a long-term perspective, valuations in that sector are relatively cheap. So if you can take that volatility for the next quarter, while some of these events play out, it's fine. But for most of your clients, I would say put it on your radar. When you get confirmation about the vaccine, when you get confirmation about the stimulus, those are two very strong catalysts for small cap value. And that's when I would definitely say start aggressively adding to your portfolio.
Great. I think you've given a great summary, and I'll open it up for questions. And just, we can't use a chat feature here. We're not allowed to use a chat feature, but what we can do is have you unmute and then ask a question. So with that, I see a lot of great people on the line here. Do we have any questions?
I don't think they're unmuted.
Loreen?
Oh, there you go. Hi, Ken.
There you go. Excellent.
Hi. Nosh, thank you. This has been so informative. Loreen, as always, thank you for taking the time to invite us to these just really great events. I had two questions. Nosh, you were talking earlier about infrastructure stimulus, and you mentioned digital and 5G. I wonder if you had any comment on green energy initiatives, since that was such an important part of the president-elect's platform. My second question had to do with the risk that may be presented to the economy by all of the rental forgiveness that has been part of the stimulus package, and any insights you might have about how those past due bills may be dealt with as part of some future stimulus package. All of those landlords who are anxiously awaiting, some kind of compensation for the rents that have been forgiven as part of this.
Okay.
Thank you.
So two very good questions. So what we are hearing is that the fiscal infrastructure stimulus package the core of that package is very much going to be on digital infrastructure. So that's the need of the hour. Having said that, if President Trump were to come back to power, then the marginal spending will be probably on roads, rails, that kind of physical infrastructure. If President Biden were to get elected, the marginal spending will be on clean energy, solar, wind, renewables, things of that nature, a little bit more beneficial to electric vehicles, things of that nature. But that's the marginal spending. And all of that will probably, start getting clarity only once we get past the elections and they start discussing this probably towards the end of first quarter. Now, coming to your second question of rental forgiveness and all of that, presently we don't have any clarity because it'll all depend on the next administration. So if President Trump comes about, very likely the compensation may take very rapidly. If President Biden comes about, from what I've heard very initially, there are two initiatives that he wants to undertake. One is to have a national minimum wage increase. The second one is some sort of student loan forgiveness or something of that sort. Now, how that plays out in the rental space, I have no idea, but we'll watch how that develops in a sense.
Great. I have a question for you, Naj. So we've been very in favor of municipal bonds. And if in fact there are taxes that go up, that of course is favorable for municipals. And also with the idea that states may be bailed out. So either it seems that they get a bailout from the federal government, or the states have to continue to increase taxation. But it seems like municipal bonds in a higher tax environment are still going to be favorable. Can you comment on municipal bonds?
Okay, so there is some bad news and there's some good news. The bad news is that we'll be paying more indirectly as well as directly. So I just heard in the local Bay Area, they're going to increase the bridge tolls from $6 to $8. And they had just increased it from 5 to 6 last year. So that's the indirect payment that the state will be taking us. They will also tax us indirectly, either on property taxes or water or something of that sort. So taxation is going to go up. Maybe the marginal brackets may get adjusted, things of that nature. So higher taxation basically is very positive for municipals. So that's the first element. Secondly, even Mitch McConnell recognizes that with the virus, a lot of the states are very depleted in terms of their funds. So some state aid, local aid will also come through. So that's the second part, which is positive. The third one being that if an entity within a state is very much stressed, so take the New York metropolitan train system, right? Literally, it has an occupancy of 10 to 15%. It just can't survive. It is literally bleeding something like $200 million per month. So then you have to go to the Federal Reserve's liquidity facility, which will come to some kind of assistance. So there are all kinds of packages being put together depending on what the case is. So overall, I would say that municipals will do very well. And sitting today, there's much better relative value in municipals rather than in treasuries. The third thing I will mention is that at Fidelity, we make it a very important point that when we invest in municipals, to us, return of capital is significantly more important than return on capital, which is to say, I don't want to look at the yield as my first metric. I want to look at how safe is that entity. So in today's environment where we still have this uncertainty about taxation, all the other risk issues that I would say, If you're going into municipals, yes, you will pick up more than treasuries. Don't stretch for yield by going into high-risk municipals.
Wonderful. I'm going to wait and see if there are any more questions that we have. And before any more questions, I'm going to go over a few housekeeping items. We are working on a year-end virtual event. So keep a lookout. We'll be contacting you by email and by phone to let you know what we figured out. So we are trying to do something virtually. The other thing is it's going to be a busy year end. So I think it is a year where we do need to look at capital gains and say, you know, do you want to take some capital gains this year while we know the tax code? So hopefully before, you know, too much longer, like Nosh was indicating, we will know who is going to be the president of the United States and have that certified and ratified and be done. And then if that's the case, you know, like Nosh said, it might be difficult to get taxes increased, at least in the first year, but we can't put it off the table either. So we'll want to have that discussion with you as far as what your own personal situation is and work with your CPA at the end of the year to see what it is that we should do for you. As well as it would be a good time to be re-looking at your estate issues as well, because you know, we could see some changes in estate tax law. We know we have up until 2025 for the sunset. However, we could see a change before then as well. So those are some important tax considerations to consider. With that, I'm going to ask, does anybody else have a question? If so, if you can just unmute yourself and we will take your question. Okay, I don't think we have any formal questions. Please contact us. We're happy to do a year-end meeting, like I said, and probably let's wait, you know, wait until the beginning of December to really look at those tax issues once we have a definitive election, and then we can talk through what makes sense for your personal situation. Know that we do take all of these things, you know, just like Fidelity has given us a great overview. I would say we would agree with everything they said and are taking those things into consideration as we're making changes as well. So with that, thank you, Nosh, for leading this presentation. Thank you to all of you for joining us, and please reach out to us with any other questions that you might have.
Thank you.
Have a great Thanksgiving, everyone, and we'll talk to you soon. Thank you.